Most experienced real estate investors have a solid due diligence checklist: environmental reports, title searches, rent rolls, lease reviews, structural inspections. The list is well established. Insurance due diligence is almost always the item that gets the least attention. And in the Florida market right now, it's an increasingly expensive oversight. In this video, what insurance due diligence actually looks like on commercial property acquisition and why it needs to happen before you're committed to the deal. I'm Brian Woods with Integrity Insurance and Risk Management. We work with business owners, commercial real estate investors, and independent producers who are serious about protecting what they've built. On this channel, we break down insurance and risk management in plain language. No jargon, no fluff, just the stuff that actually matters when something goes wrong. The Florida commercial insurance market has changed materially over the last several years. Carriers that were active in certain property classes or coastal markets have restricted their appetite or left the market entirely. Properties that were routinely insurable at standard terms 5 years ago may now face limited options, higher deductibles, coverage restrictions, and placement with non-standard carriers. Discovering that reality after you're committed to closing, when you're committed to the asset and need coverage to satisfy the lender with no negotiating leverage, is a fundamentally different position than discovering it during due diligence when you can factor it into the price or walk away. Insurance due diligence is not just about what coverage costs. It's about what's available on what terms and whether those terms work for your financing and investment thesis. During due diligence, 4 things should be on your request list: the full current policy, not just the one-page declaration summary, but the actual policy forms and endorsements. The declaration tells you the limits. The forms tell you what those limits actually cover. 5 years of loss runs, the claims history for the property, one of the most informative documents in any real estate due diligence package. Any open or recently settled claims, including any outstanding financial reserves on claims still being worked through. Certificates of insurance from every tenant to verify coverage they're contractually required to carry is actually in place. Real quick, if you're finding this useful, subscribe to the channel. We put out new content every week on commercial insurance, risk management, real estate protection, and business liability, all in plain language. It's free, and it'll save you from learning these lessons the hard way. A 5-year loss history isn't just an insurance question. It's a property condition question. Multiple water damage claims at the same location point to an unresolved condition, not just bad luck. A history of slip and fall incidents in specific areas suggests a site issue that hasn't been corrected. A large open claim with a significant reserve represents a financial obligation that the closing may transfer to you. A clean, quiet loss history is a genuine positive thing. Patterns or open items that are flags that warrant specific investigation before you commit. Roof age and condition. Carriers have tightened significantly on roof age in Florida. An aging roof may mean restrictions, exclusions, or required replacement before standard coverage is available. Electrical and plumbing systems. Certain older systems types are on insurers' watch list and affect placement options. Wind zone and coastal designation. Different markets, different pricing, different terms. Flood zone designation. FEMA flood map classifications affect cost and availability of required flood coverage. Prior permits and code compliance. Unpermitted work or open code violations create both coverage and liability exposure that transfer with the title. Coverage needs to be in effect at closing, not applied for after the fact. Your lender will require proof of insurance as a closing condition. Build the insurance placement process into your pre-closing timeline, not as a last-minute item. The day you close is the day you assume the risk. A gap between the seller's policy expiring and your policy taking effect is real exposure, even if it's measured in hours. If this was helpful, share it with a business owner or investor who needs to hear it. And subscribe if you haven't already. New content every week. If you're evaluating a commercial property acquisition in Florida and want to understand what the insurance picture actually looks like before you commit, reach out to Integrity Insurance and Risk Management. The link is in the description. I'm Brian Woods with Integrity Insurance and Risk Management. We'll see you in the next one.